So in this case, if Google were to import televisions made in China and they bring it into the United States, Google is the company responsible for paying the additional tax, not the country who makes the item. Anyway, this is obviously a stupid example just to illustrate a point, but apply this thinking towards practically anything that you buy, from clothing to batteries to cars and electronics. And all of a sudden, that additional tax makes locally made goods that much better. But is that something that could actually replace the income tax? Well, surprisingly, the way we pay taxes is actually a relatively new concept. In fact, for the first 100 years, the US government funded itself almost entirely from tariff revenue on things like tobacco and alcohol. That's because back then, the government was relatively small, and when you only spent 3% of your total GDP, it doesn't take much to run the entire country. However, by the late 1800s, policymakers recognized that tariff revenue was a rather inconsistent income source, and it was either great or a bust during times of prosperity or a recession. So when the US entered its Civil War, a temporary income tax was implemented to help raise a little bit of money. How much, you might be wondering? Well, back then, it was a 5% tax on incomes between $600 to $5,000, a 7.5% tax on incomes between $5,000 to $10,000, and a 10% tax on everything above that.